Good morning, sir. I'm Anuka Diali from MCOM second semester, and today I'm here to present a short presentation on the topic Role of RBI in Foreign Exchange and Regulation in India. So, firstly, I'd like to start with RBI. The Reserve Bank of India, which is chiefly known as RBI, is India's central bank and regulatory body responsible for the regulation of the Indian banking system. It was established on 1st April 1935 in accordance with the Reserve Bank of India Act 1934. It has 226 offices, in which 4 are regional offices located in the metropolitan cities. So, moving on to the another topic, foreign exchange. Foreign exchange is the process of changing one currency into another for a variety of reasons, usually for commerce, trading, or tourism. For example, one can swap the US dollar for the euro. Foreign exchange transaction can take place on the foreign exchange market, also known as the forex market. The forex market is the largest, most liquid market in the world, with trillions of dollars changing hands every day. There's no centralized location, rather, the forex market is the electronic network of banks, brokers, institutions, and individual traders. So, another one, role of RBI in foreign exchange in India. The role which are played by RBI in the foreign exchange are regulating and managing foreign exchange of the country, regulating transactions related to external sector, and facilitating the development of the foreign exchange market, ensuring smooth conduct and orderly conditions in the domestic foreign exchange market, managing the foreign currency assets and gold reserves of the country, controlling domestic money supply to influence foreign exchange market. So the another one, role of RBI as a regulator in India. The role which are played by the RBI in regulation in India are the Reserve Bank of India vested with the responsibility of conducting monetary policy. It issues the license for opening banks and authorizes bank branches. It formulates, implements, and reviews the prudent norms like the Basel framework. It maintains and regulates the reserve of the banking sector by stipulating reserve requirement ratios. It inspects the financial accounts of the banks and keeps a track of the overall stress in the banking sector. It regulates the payment and settlement system and infrastructure. It prints, issues, and circulates the currency throughout the country. The RBI is also the regulator and supervisor of the financial system in India. It conducts economic research work to promote growth of economy. It acts as a banker to both the government of India and state governments, and therefore handles their current financial transaction and also manages the public debt. Now, RBI also act as a controller of credit. RBI brings timely changes in its credit control measures and sometimes uses more quantitative credit control measures and sometimes qualitative credit control measures as per the economic requirement. The major tools to regulate the credit control are number one, bank rate. Current bank rate is 6.25%. When banks want to borrow long term funds from RBI, it is the interest rate which RBI changes from them. The bank rate is not used to control money supply these days, although it provides the basis of arriving at lending and deposits rates. Number two, cash reserve ratio. CRR is one of the most commonly used by RBI as quantitative tool of credit control. The ratio specifies minimum fraction of the total deposits of the customers. Number three, statutory liquidity ratio. The current SLR announced by the RBI is 18%. The share of net demand and time liabilities that bank must maintain in safe and liquid assets such as government securities, cash, and gold is SLR. Number 4, repo rate. The repo rate is the rate at which the nation's central bank gives money to the commercial bank in the time of cash shortage. Monetary authorities use the repo rate to limit inflation. Thank you.